Hi, welcome to this video today, which is all about forex technical analysis. I'm going to give you some techniques and tips which will help you get a trading edge in your strategy and help you make consistent gains. And I'm also going to go over what I consider to be a fatal technical analysis mistake. And I want to start with the mistake first of all. And to illustrate what the mistake is, I want to refer to an interview Jack Schrager did with a guy called Joe Ritchie. Now, Joe Ritchie is known as one of the best options arbitrage traders ever, and he was doing a talk on trading. And there was a lot of people, from the trading industry there, and one of them was a guy called Richard Dennis. You might be familiar with that name. He was actually the guy that devised the Turtle trading rules and system, really successful technical system. Two of them were having dinner afterwards. And Richie actually said, what fundamental information do you use in your trading strategy? And Dennis kind of sneered, I don't use any at all. He goes, you cannot dispute the fact that all fundamental information is reflected in the chart. And Richie said to him, and you also can't argue that all the technical information is reflected in the chart. And Dennis actually smiled and said, yeah, good point, I hadn't thought of that. So what can we learn from that? Well, what we can learn from that is that we all see the same levels on the chart. Most of the time, the big levels are there for everyone to see. And this creates a problem, because if everyone else has seen the levels and you've seen them, and 90% of people lose, you've got to work out a way of trading those levels in a different way to the majority. So how do you do it? Well, my own view is that most traders who come in the market just want to trade in what I call the traditional way, and that's either they learn from textbooks, the textbook way of using technical analysis. And I must admit, I've probably got about 100 books on technical analysis, all telling how it should be used, roughly all the same, will not give you a trading edge. And you also get a lot of people who buy endless systems, technical systems that are automated. And a guy was asking me the other day, which is the best one to buy? There's so many of them. Well, there's so many of them because none of them work. You've got to actually work out a trading edge yourself, to get away from the majority. So how do you do this? Well, I kind of learned how to do it, devise my own strategy to go against the majority, really when I was working as a broker. Because when you work as a broker, you really do see what the retail traders do, en masse. And I'll give you one tip, which is a great way to get away from the majority straight away. Be careful where you place your stop. Placing your stop is as important as your entry point, or even more important in my view. Why? Because traders always place their stops too close. I'll give you an example. You get a big price spike up on a chart. The next day, you get a sort of down day. Where do the herd place their stops? They'll come in on the down day. They think, I'll have a tight stop just behind the high. You'll normally be about 5 or 10 pips behind the high. That will not make money longer term at all. Market is designed to take out those stops. And you often get traders say, well, my broker took my stop because it immediately goes up there and comes back. Well, it's just basically taken the stops to the majority and it comes down. That's what the market's going to do. Also, you see a lot of traders always with a stop too close on a breakout. And they'll put it like once the breakout has occurred, they'll put it right tight behind the level. Within a few pips. That again isn't going to help. You've got to have your stop one level back. People say, in that case, you create more risk by doing so. No, you don't. You actually lessen the risk. You've got to take a realistic risk to stop to make any money in forex trading. And all these, I call them idiots who say that you can place stops of 10 or 20 pips. Have just never traded. You need stops of 50 to 100 pips. In any pair, really, most of the time. Now, let's take entry levels. Okay, so let's say you've got a big level on the chart, you want to trade it, Which you find a lot of the time, this is a mistake that the majority make, is they want to trade straight through the level. So let's say it's 135 in the euro, for example, they'll come in just a few pips above it on a breakout. Never ever do that. Always leave it 20, maybe even 30 pips to clear the level. Okay, a lot of noise is created around the level. A lot of it's to do with the spread. So you want to clear the level. Okay, you might miss a bit of the move. That's fine. But as we know, most breakouts fail anyway, so it's a good filter. So when you're using trend lines and so forth to get in on the action, don't try and come in too quickly. Always get good confirmation before you come in. Be prepared to miss a little bit of the move. It doesn't matter as long as you make money from the trade. The other thing I'd recommend is, let's say you use indicators. You can read lots of textbooks who will always tell you the same way to use an indicator. So, for example, a stochastic, which is an indicator I love, a turn down through 80 or a turn up through 20, that's the signal. You just experiment with the indicator yourself. I mean, I will do 80 turn downs and 20 turn ups, but I will often take a signal just any momentum divergence at all if it's an extreme. So experiment. Don't just do it the way that it's taught in the textbooks. And there's many indicators that you can use in a slightly different way, and they can help give you an edge. Richard Dennis once said, if you've got a chart formation that looks nice and comfortable, it looks a really good setup, you want to be wary of it. If it looks comfortable, don't do it. Do the uncomfortable chart setups, the uncomfortable trades that the majority don't do. You always want to get worried if too many traders are looking at the same chart formation as you. Now, I've always said, forex technical analysis is very, very simple to learn. But what you've got to do is get out of the mindset the majority of traders have and how they use it. Think about how they think, and then get your strategy to be slightly different. If you want to win, you've got to have that trading edge. And if you trade like the majority, or what is commonly accepted investment wisdom, I just don't think that you're going to win. You have to be doing something different. You must have that edge that you're really rock solidly confident in to make money long term from the markets. So keep it nice and simple. Think about how other traders trade, and then basically do the opposite. Well, not do the opposite, but make sure that you compensate for what they do. Just really want to just finish up with the difference between fundamental and technical analysis, which is better. Okay, and a lot of technical analysts say, fundamentals are just not important at all. Well, a lot of people make money with fundamentals, okay? A lot of people make money with technicals. One isn't better than the other. I think you could say that technical analysis is easier and quicker to learn. I mean, anyone can learn it. Fundamentals, I think, obviously it takes a little more time to understand them and trade them. What I would recommend is you actually keep an eye on the fundamentals. You don't have to make a big study of them, but always look at them to see where the big fundamentals point. Okay, at the end of the day, the chart will reflect the big fundamentals. So if you have long-term trend following, knowing where they're going is a good idea. Also look at the fundamentals to give you warning signs of what might happen on the chart. For example, if the market is expecting a really bullish news release, and it's the whole consensus for a bullish news release, then that's giving you an indication already that the market might reverse before you see it on the technical picture. You might see it on the technical picture, you might not, but if you don't, you're going to get a warning sign from that. That might allow you to adjust your strategy to come in slightly earlier, possibly, than the majority will. I mean, there's plenty of ways of building a technical strategy that works, but I do believe that if you actually keep an eye on the fundamentals, it can give you more confidence in your trade and can give you warning signs of what might happen. So that is the video today. Just a few ideas there. If you've got any questions or queries or want any more, please feel free to write to me. So thank you very much for watching me as usual. Take care. Have a good day.